We're delighted to be back and to continue the Viewpoint series, which provides you with a high-level summary of updates in the Irish legal and regulatory market. Thanks to our colleagues Adam Sinclair and Aidan O'Regan in Hong Kong for covering the Irish Investment Limited Partnership in the last episode. And today, James and I are going to focus on private credit and Irish solutions that we are seeing in the market. Private markets continue to see significant volume of activity on the funds formation side, with private credit and asset-based lending strategies having become leading contributors for workflows in our team. The overall uptake in products is also helped by the removal of the Central Bank of Ireland's pre-submission requirements that we discussed in detail in our last Cayman Islands Irish team Viewpoint. Over the last 3 to 6 months in particular, the consistent themes in private credit seem to be the resilience of the asset class relative to overall market volatility. General consensus from our clients and their peers in the market is that non-bank lending to private businesses can actually be done better in many respects by their private credit team than traditional banks, as the managers have specialities and deeper expertise in the underlying assets and businesses of the borrowers, and also have the capacity to engage with senior management when challenges arise, as we've seen in recent times with COVID and rising interest rates. When you combine their confidence with the continued shift in focus by traditional banks and their risk aversion towards corporate lending, the recent financial and institutional turmoil with US and European bank failures, etc., opportunities have really opened up further for funds in the private credit space. Briefly looking closer at the products themselves, perhaps you can give us some colour on what we've structured for our clients, James, and the strategic thought and considerations that got us there.
Managers have been as focused as ever on capital raising and readying their business and investment teams for opportunities in the market. So it's no surprise that initial fund structuring considerations have been heavily influenced by feedback by client sales teams on the target investors in their markets. There's been a mix of fine-tuning new products for larger managers in their subsequent fund vintages, and almost blank canvas collaboration with others who are new to European funds and are new to private markets. The end product from an Irish perspective has primarily been the ICAV with the Quaife regulatory APRA, as the ICAV regime has proved itself flexible enough to accommodate many private fund type strategies and features, despite the unitised structure of the fund. For example, capital commitment and drawdown mechanisms, distribution waterfalls and carried interest, and excuse and exclude provisions in asset allocation. Some of the significant global players have established multiple ICAVs with private credit, private equity, real estate and infrastructure strategies. And in our experience, having a strong understanding of the intended fund operations and asset class behind the legal documents, in addition to common toolkits that provide managers with enhanced flexibility, has been the key to optimizing these funds. It's worth noting the investment limited partnership is an alternative option that has been used and is meaningfully explored in our engagements, notably because clients can get a good operational synergy with their new or existing Cayman partnership products that our colleagues work on. And because both ICAVs and ILPs can be structured as umbrella funds, each therefore complement our clients' ambitions to quickly grow and develop multiple products in their offering. Some recurring factors with influence on the structuring side for us have been timing and channels for capital raise and downstream target assets. In parallel to our formation and advisory work, our colleagues in global registration services have positioned clients with a better understanding of the strategic route to access capital, taking into account the European cross-border distribution framework and the private placement regimes elsewhere. With the European fund, the natural focus and priority is Europe, but we've seen an increase in managers with a greater blend of global investors coming into their European fund. And this has prompted earlier discussion on whether an EU AIFM is needed or if a non-EU AIFM is sufficient based on the investor priorities of their sales teams and the target fund assets. Downstream investments is the other most prominent factor, so we continue to work with clients and their advisors from an early stage to ensure things like market norms and deal execution for counterparties and opportunistic deal warehousing are taken into account within the framework and overall launch timeframe for the Irish fund operation. Ultimately, we are constantly listening to different stakeholders to figure out what matters most in the overall puzzle. So our mindset on these two items during the formation workstream and the ability to leverage the expertise in the Maples Group has proven very beneficial for clients.
As we wrap up, it's also worth highlighting elements related to your points such as direct lending, private placement that are under review more generally in Europe under AIFMD2, which our colleague in Dublin, Aaron Mulcahy, has discussed previously in the Spotlight series. So we will continue to follow developments there as part of any early stage product structuring. Many thanks, and we look forward to speaking to you again soon.